Right, good morning and welcome to What's Up with the Markets session. Today we're going to have a look through some indices and some commodities. And before we do that, I have to tell you that everything we cover here today is of a general investment advice nature. There's no specific or personal advice that we give here. And of course, past performance is not an indicator of future performance. The other thing I'd like to tell everybody today before I get into this is that even though I do this analysis and I've been doing it for about 20 years now with our customers, where I go through the markets and just see what the status of the markets are. I don't do this as part of my investing decision-making process. I'm, as our customers know and have known for many years now, I've been a mechanical systems trader. And if I wasn't doing this for our customers, I would probably do this every 2 weeks or so. I know some people may do it weekly, but there are people who are discretionary or subjective investors and traders who basically do this every day that I take you through, which is I don't find necessary, and one of the main reasons why I became a mechanical rules-based investor. So I do this. Sure, for my own edification, it is great to get an idea of where the price action is going in the markets, but it in no way comes into my decision making on how I manage my portfolios, how big my position sizes are, what my exposure to the market is, and when I buy and sell particular stocks. None of what I cover here today goes into that. And thank you for customers reminding me to say that. So that done, let me now move over into share my screen, and we'll get into the charts, and we'll start doing our analysis. Right, as always, starting with the Dow Jones. This is a bigger picture of Dow Jones. You can see the COVID-19 crash on the left-hand side, a run up out of that, and now we've had this bear market. It's a sideways moving, wide-ranging, sideways moving market. I'll just zoom in a bit over here, and you can see it's been a bit messy. As I've said a couple of weeks ago, the S&P 500 looks a bit better. Now let's just zoom into the right-hand side before we get to the S&P 500. We've got this almost like a upside down cup and handle that may be forming. The handle hasn't formed yet, but this sort of rounded top, which isn't a common pattern that you see, although it does happen in the Dow Jones more regularly than what you'll see in other charts. But the important thing here is that we're right on support, and not only on that upward slanting trend line, the red one, but also on the support and resistance zone. So we had the breakout out of resistance, and now we've seen this weakness, this retracement, which will put into better perspective when we have a look at the S&P 500 and the NASDAQ composite. So things are definitely not as rosy as they were. And the big question 2 weeks ago, that is, and the big question is this just a normal retracement as we have in any market, or is this the start of some bigger negative things to come? So right now the market is definitely hanging in there. And to put a little bit of perspective on this retracement, I'll start off with this Fibonacci line, which is that you can see the orange line over there, which goes from that trough to that peak, just to measure what this retracement is relative to the run-up we've had since October 2022, some 10 months ago, or even 10 and a half months ago. And you can see that the retracement we've had is a 23.6% retracement. Now, that is a absolutely 100% normal retracement to have in an uptrend or even in a downtrend. But the important thing to say is that is a shallow retracement. If we start getting down to 38.2, which is down here at 4180 on the S&P 500, which is about 140 odd points lower than where the 23.6 is, that support line over there, you can see the 4343.81 is the actual 23.6 retracement support line, but the S&P 500 is currently at 4387, so about 200 points above where that 38.2 support is. Now, if we go down to that that is still not, anything to really worry about, although it's because that at 38.2 retracement on the S&P would also be quite normal relative to this run-up that we've had since October 2022. So the breakout, the run-up that was looking quite healthy there, did not continue to be a longer run-up. It's cut a little bit short, and we've now had a retracement. So none of this is really a major thing to write home about, but we do want to take note that this is what is happening, and it is price action. So weakness in the Dow, weakness in the S&P 500, but on our SPA3 investor system, you can see that this is still, the S&P 500 is still an open trade. The last signal was an entry signal. There's the trailing stop, the gray line over there. So we haven't transgressed that yet. So this is still an uptrend on the index. If you were doing a medium to longer term trade, an unleveraged trade, say for instance in the SPY, the SPY, the S&P 500 ETF. So the volatility is still low. It's down at 10.26. That is the value of the S&P 500. Sorry, that is average true range measured as a percentage of the S&P 500. So volatility is still relatively low, even though we've had a bit of a downtrend. Saw an uptick here to over 1%, but 1% volatility is low on the S&P 500. Of course, if we had some big ranging, wide-ranging down days on the S&P 500, that would change, and you'd see this volatility line start rising stronger, which would be another cause for concern, but at this stage, still in manageable levels. Right, what's happening in new highs, new lows? I'll just have to zoom out to get a better picture on this, on the S&P 500. Right, this gray line is the accumulative new high, new low line. And you can see it hasn't actually started rising like it was back here coming out of COVID. You can see coming out of COVID, it was flat and then rose higher over there. We had that strong bull market in 2021. So that hasn't happened yet, and in fact has a bit of a tip down. So a few more new 52-week lows and 52-week highs. That is a sign. It's not a positive sign, not a bullish sign, but it's not a bearish sign either at this stage. The NASDAQ, sorry, this is the cumulative advanced decline. This is the total number of stocks versus those going up versus going down. You can see the gray line has started falling, dropped below this moving average I've got on here, which is a pretty short-term moving average. But obviously, with the falling of the index and the S&P 500, we've had more stocks declining than rising. Not a major concern, but one of the other early signs to keep an eye on as a market breadth indicator. Similar with the simple 150-day moving average, with the decline we've had in the index, which is the S&P 500 at the bottom over here, you can see that there are now more stocks below, because there's the 50% line. There are more stocks below the 150-day moving average, which is a little bit of a medium-term moving average for the stock. So there's more below the 150-day moving average than above the 150-day moving average. Their respective moving averages for each stock. Right, sentiment indicator now, looking at the consumer discretionary index, or the SPIDER, the ETF on the consumer discretionary index, which is XLY, and we're comparing. So that's the actual XLY price action. We've had a sell signal on our mechanical system there, which is saying there's weakness. So it's broken through a volatility threshold, which is a trading stop line that we have, the gray line that you can see there, meaning that there is sufficient weakness to give a sell signal on the sector. Now, what we also do here is we run in this second chart, we run a relative strength against XLP, which is the consumer, the consumer staple SPIDER, the sector index, and you can see that they're basically both going down the same. So there is you can see that line's going sideways over there. But the CIROC indicator, which is an indicator of the relative strength between the two sectors, is still rising, which means it's still bullish. Now, this is a bit of a longish term one. It's a medium to long term setting I've got on this trend following indicator. So it hasn't tipped over yet, even though we've got one indicator saying over here that a volatility trading stop threshold has been broken. This indicator over here is still saying stick with it. And you can see the weakness in the S&P 500 there. So this is a sentiment indicator, a little bit negative, some conflicting indicators there, which is what you have when there's indecision, which is really what's happening in the market right now. And there's a whole bunch of whys behind that, which, as you know, I don't go into the whys, I go into the whats. The whats is the price action, the whys are the reasons. We can drive ourselves crazy trying to find out all the whys, even in hindsight, let alone in advance to make decisions. So I leave all the whys aside, and all the whys get built into the price action, and then I look to see what the price action is doing, and I follow the what. That's what we do. Just can't get distracted with the whys. Otherwise, you'll never know what all the whys are. All those variables, those geopolitical and variables that have nothing to do with the market. Just forget about them. You just will never be able to get on top of that. It's just really a mindset quagmire of trying to do that. Right. Next thing, let's move on to the US dollar index. US dollar index measures 6 major world currencies against the US dollar. And effectively, that's been rising. So this is a bit of a sentiment indicator as well, and on the S&P 500. So what are we looking at here? The blue line is the S&P 500. The bar chart down here, which has been falling, is the US dollar basket index, and you can see that it's broken above that trend line. Now, 2 weeks ago, we were talking about keeping an eye on that. So what does this mean? This is the relationship between the US dollar and equities. Now, the US dollar the US dollar basket and equities ratio has some validity. There is certainly a sufficient evidence, as I've said before, that when the US dollar is falling, stocks tend to rise, and when the US dollar is rising, stocks tend to fall. So what's happened here? We've had some weakness in the S&P 500, the blue line. See, I've got a trend line on there. We could also put one below, just right-click, parallel, and bring that down here, just to see where that goes. And it would be down over there. You can Control S to save that. And now that's locked in. But we are seeing this breakout here in the US dollar index. So the US dollar is strengthening against its basket that it's measured against. And I've got a Ciroc indicator here. You can see I've gone and done some manual back testing, if you like, to just really look at the validity. Our customers can download this analysis, and you can just import it into your instance of Beyond Charts, and you can look at this yourself and keep an eye on it if you want to do it more regularly than every 2 weeks when I do it. But we've also got what is an entry signal over here on the US dollar index. And that means that this is rising, and this is the correlation that I've looked at. So when we get that rise over there, it's potentially if you like, a small weight of evidence going into what you should do with the index. And so this is one of the early signs that we maybe got, and it's too early to really go and sell all your stocks or anything like that, which mechanical investors would not do. I certainly wouldn't do that. And just because this US dollar is rising, but it's one to keep an eye on, and probably one of the more important ones to keep an eye on in the short term, to see what happens in this relationship, this inverse relationship between equities and the US dollar. So another early sign there to add to the other 1 or 2 we've seen. The VIX index is starting to rise a bit, still at pretty low levels. If you look back long term, it's still way down at the bottom of this bottom threshold over here. So not too high yet, and part of the evidence to say the market's hanging in there. Right, onto the NASDAQ. There's the downtrend of 2022. There's the breakout. There's the entry signal that we had to get in back in, when was that? January, end of January this year. Lovely uptrend in the channel. The volatility index, you can see, the volatility has been narrowing over here. The trailing stop has got closer and has given an exit signal on the NASDAQ. So in our short to medium term trading system, the people who trade the SPA3 NASDAQ, they would be in cash now, 100% in cash, because that's a short term system. And of course, we want to keep losses there to small losses, much smaller losses, because we don't have as big a stop, if you like, or exit signal. It's a more sensitive exit signal in the shorter term system. So people would be in cash there, waiting for re-entry on the NASDAQ. But the NASDAQ is still within this channel that we're using subjective technical analysis now, and has moved to the bottom, which, from is this the bottom of a trough? Is this a dip to buy? It's still too early to tell. But one other bit of evidence we can look at over here is what I did on the S&P 500. Is I went back to October. In fact, on the NASDAQ, it was actually a bit later than that. It was December because it underperformed the S&P 500 for that first 2 months from the S&P 500's trough back in October last year. It lagged for another couple of months. You can see that it underperformed the S&P 500 here during that time, and then hit its trough in December. And I've drawn this the Fibonacci retracement line from that December trough, and you can see since then it's outperformed the S&P 500, but is now starting to, the relative strength line is starting to drop a bit, indicating a bit of weakness relative to the S&P 500, which happens. Of course, no line, no trend, no ratio goes up or down in a straight line, and we're going to see this little bits of noise. And our challenge is to overcome that noise and not knee-jerk react or overreact to what's happening. So we've also, this retracement of the Fibonacci is dropped just below the 23.6, which is a little bit of a steeper retracement, deeper retracement than what we had on the S&P 500. Remember, that was at 23.6%. And you would expect that because we've had a little bit of outperformance on the S&P 500 and compared to the S&P 500, which means that we can expect a little bit of a deeper retracement. Hasn't quite got to 38.2% yet. 38.2% just nicely aligns with the bottom channel line over here. And at this stage, looking at those three indices, my summation is that the trend, the medium to longer term trend is still up. This is a normal retracement. The indices are hanging in there, but it's in the balance. You know, we can't predict the future. Don't try and predict the future. As Mark Douglas said, his first fundamental truth is anything can happen, and we got to go by that. We've got to go by that principle. We've got to go by that truth that anything can happen, which keeps our minds open to both sides, upside and downside. So I know we want things to go up, but we've got to be objective in the moment, and we've also got to look at what potentially can happen on the downside as well. So at this stage, we will, in the next 2 weeks, we need to see whether these troughs that are forming now are actually hold. You know, we did have on the S&P 500, which I didn't point out, is that we had a higher open than close on the S&P 500 yesterday. Well, let's just go and look at that rather than, we've got the pictures, so rather than talk the picture, let's actually go and show the picture. What I mean by that is, so that's an oops. So we had a open above the previous day's high, and then a close below the open on today's bar. So that's Larry Williams. He came up with that name. He calls it an oops, and really that shows that started with buyers in control, and the same thing you can see on the NASDAQ. Same thing happened over here. We had the open above the high and then finished into the previous day's bar. So that oops is just showing strength on the open, weakness on the close, buyers in control at the open, sellers in control at the close, which typically augurs for at least another day or two down days. So be prepared for some another 2 red, maybe 3. I don't know. I can't predict, but typically we're going to have, and it's not 100% of the case that it happens, but on probability, we're going to have a couple more red bars at least into the next few days. So from a mechanical investor's perspective, I think we're not 100% invested. I think we've had 1 or 2 sales, and that's happening in the Australian market as well. So going a little bit into cash at this stage, which is what your mechanical system should do, because it doesn't know what's going to happen either. It can't predict anything. It's not supposed to predict anything. So a little bit of caution at the moment is really what's coming up with this, but the longer term trends are still intact at this stage. So the jury's out on whether this retracement is the beginning of something bigger, or whether it's close to being done and we're going to resume the medium term uptrend. Okay, now I'll just whip through. That really does set the scene. I've got a couple of commodities to show you and some things to mention there that's changed in the last 2 weeks. So I'll get to that in a moment. But just some breadth of market on the NASDAQ, a little bit of weakness there, drop below the trend line. So that is the cumulative new high, new lows. Breadth of market showing a bit of weakness on the NASDAQ. On the NASDAQ 100, those stocks above their 100-day moving average, still more than half of them above their 100-day moving average. So showing a little bit of not as weak there as the S&P 500. Right, here's a little bit of news, and I've done some more analysis on this just to do some manual back testing, if you like, on the effect of the 10-year Treasury note. That's yields on the 10-year bond. And remember, we were talking about, is this a declining a triangle, or is it a or is this trend over here, the breakout above it, a bullish pattern, which can be a continuation pattern. So continuation pattern or reversal pattern is what we were talking about. And we've had this breakout above this channel line. So this is really now prices showing us that this is a continuation pattern, and that means that interest rates have gone higher. What has happened? The index, the index is this is the S&P 500 down the bottom over here, has started to fall away. Now I've got in this middle chart, I've got a long-term a smooth index rate of change indicator, a trend indicator on that. And one of the little bit of extra work that I've done, and I haven't put all the lines in yet, is that the correlation between the yields on the 10-year bond and even the 30-year bond as well don't have a high correlation with what the S&P 500 does. And just as an example of one, there are more around. I can just show you here that where's the example that I got? Let's just go back. Probably the best example is over here. Here it is here. So there we had the 10-year Treasury note yields rising. So this is an entry signal on the yield. And what's supposed to happen here, I've got a red dot line, is that the index is supposed to fall if there's a high correlation. So yields rising, index falls. Well, that didn't happen. You can see that while interest rates rose, this is going back to second half of 2020, the index continued to rise and quite strongly, right? And then we had the yields start dropping over here. So because yields are supposed to drop, it's supposed to give an entry signal. Why it's green, it's supposed to be a bullish sign for equities, and sure, equities continued to rise. And then we had the yield started dropping again. Index is supposed to fall, it didn't, continue to rise. So when you go back and eyeball this over a long period of time, you find the correlation between yields rising and index falling is pretty low. It's not a high enough correlation to really start making decisions on. And I say that because what's happened over here, obviously, is that we've had this breakout over here. Yields are rising, index is falling. That doesn't mean it's going to continue. So one will keep an eye on as a weight of evidence, if you like, an indicator, a sentiment indicator, if you like, on the market, but not one that we'll put a lot of credence into in future. Right, onto the All Ordinaries. All Ordinaries is still a dog's breakfast, as I said. It's pointed out to me that I said that last time, 2 weeks ago, and it hasn't changed yet. Stuck in a range, very messy. Whipsawing will happen with trend following systems in a fairly narrow range like this, and it's continued. Got to resistance over here, and this blue overhead resistance didn't break through, fell back down, on its way back down now to support, which is this zone over here. And you can see this underperformance of the S&P 500 been going on all of this year, bar the last couple of months where they've both been negative at the same rate, hence the sideways moving blue line over there. So difficult in the Australian conditions, has been better in the US over this year. And let's go and have a look at the share price for Australia, which is the A dollar against the US dollar. So despite the US dollar being relatively weak for a period of time, the Australian dollar has been even weaker than the other 6 currencies that the US dollar basket is measured against. So this is wide down-ranging trend, which started in February of 2021 and has continued. So international investing view of Australia has not been positive for some time, and it's now right down now in this support zone right down over here. And it's in that support zone now. So time will tell whether it breaks below that support zone. Where can it go? Well, it's all the way down to here around about the high 50s. At the moment, it's 64 is where it's at. And in 2000, it got all the way down to the high 40s. So not good at the moment on the Australian dollar. And that means that people aren't buying Australian dollars around the world. And typically the Australian dollar will rise when money comes into Australia, which is obviously not happening at the moment for investing in other purposes. Okay, just a little bit of a barometer on developing markets is the Bovespa, which is the Brazilian index. The indicator has picked this nice these nice trends. These are pretty good trends because that goes back to 2020. So that's a 3-year sideways range trading market over here, and picked them pretty well, but got to near resistance. That's the all-time high on the Bovespa, and looks like it might traverse all the way down, not a prediction, to the 10,000 level here, which was where major support is at the moment. So developing markets also not that strong at the moment. Quickly on China before we will rapidly go through commodities in a moment and look at what Bitcoin's doing. It's had a major move. This is the large cap 50 stocks in China going nowhere. Broke out above this trend line, this grayish trend line I've put over here, back onto now finding support at that zone. And I've been underperforming the S&P 500, you can see, for some time. So large cap Chinese stocks not doing well, and that's been one of the whys that's been going around the marketplace in the last week or two. That's led to some of the weakness into, well, one of the whys that we're finding with Harry hindsight, that nobody knew it beforehand, but certainly there's weakness in China, and you can see here on the broader Shanghai All-Share Index is that it's also going nowhere, underperforming the S&P 500, sharp falls down and heading towards support again. So weakness certainly there in their stock market. Right, I'll quickly head over into commodities now. I'll just go to the top chart I want to look at, the CRB index. And this was this breakout of this downward channel that we spoke about a couple of weeks ago. And you can see commodities underperforming equities. That's what this bottom line is telling me over here. It's a relative strength line, relative strength ratio against the S&P 500. We had this breakout. Now we have to see if this breakout persists or not. And that's mainly due to oil, as we'll see in a moment. It's the only commodity that has really got any go ahead. This is gold. Gold is also in this range, moving sideways. I've just drawn another gray channel over here just to change the trajectory. I haven't removed this other black dark channel over here to see whether the gold price drops back into that downward channel. So not believing that it's out of it yet, I've just drawn the gray channel over here, and there was a breakout above that, move into the gray channel, and all that is measuring, using channels to measure gradient of price movement, if you like, the gradient of the down channel, which you can do on the flip side too, and measure gradient of up channel to get a relative eyeball mark 2 on it. I keep the other channel there just so I can see if it reverts back to the original gradient of downtrend or not. So just a little technical analysis technique. And another on the gold versus stocks ratio. This is the S&P 500 relative strength, and you can see that they're more or less both falling at the same rate. So no outperformance or underperformance there of gold versus stocks. We'll slip through nothing to report home on silver. Quickly have a look at copper. Bellwether are certainly on small to mid cap miners in this large downtrend. Got to its all-time high back there in late 2022, but in this downtrend and ranging sideways. So again, and the gold, the copper to gold ratio, which is this bottom chart over here, is you can see that is in a downtrend. This red line over here is a median line, if you like, for long-term measurement of gold to copper ratio. So copper underperforming gold, and really as being a bellwether on economy, because copper gets used in more and more things now. It's not a positive sign for small to mid cap stocks in the bellwether copper price. Right, oil, this stands out here like the proverbials breakout, and this is what's leading into the CRB index having its breakout. And you can see just slightly tip over here. This is the relative strength against equities. So how's oil doing against equities, that ratio? Oil was underperforming. I'll just put a trend line in here. Was underperforming equities, S&P 500 for a long time. Now you can see the breakout just happening over there. So oil rising while stocks are falling. And so that could, if you want to go to pockets of the market, is where you might find some short-term trades in oil stocks. Fossil fuel. Whoa. Right, quickly on to the Bitcoin versus the US dollar. Nicely formed channel over here. And one thing that Bitcoin does do is its technical analysis, its support and resistance, all of the Fibonacci's, they all apply pretty well to so if you want to practice your skills, they apply well to Bitcoin. So if you want to practice your technical analysis skills, this is a good price action chart to go to get it. And it does tend to follow, you know, subjective analysis pretty closely. Depending on where your skills are, you might want to use that subjectively. But there's been a break. It's certainly a break. You can see this rise strongly down to the bottom end of the channel. That channel had formed at that stage. We had two troughs over here, so two touching points, and then it came down to that third touching point, absolutely spot on. You know, all I do is I draw these channels, save them, and then extend them as more price comes, and it behaved very closely to that. Went back up, found this long-term support resistance zone, which I've had in there for months, maybe years. It found resistance there, indecision, was it going to break out or not? Went slightly below and bang. It's the resistance was too much to bear, and it's fallen below its support channel line. So where is this going to go? Well, I don't predict, but you know, if the textbook plays out, it's probably going to go. It's going to maybe find some short-term support, you know, around about here. I could put another zone in here. You can see there's a shorter-term zone just there, and it might find some support there. I'd make that a dotted line. I'd just right-click, modify, and make that a solid. We go to dashed, and indicating it's not a strong support resistance zone, but if it falls below that, the odds are that it's going to go to the next support zone, which is down here at 20,000. So it needs to find support here. If it does find support here, that'll strengthen this dashed support zone as a support zone, and might leave it there depending on what happens, really. But not auguring well with Bitcoin, and confirmed with Ethereum as well. We have spoken in past with customers about using the Siroc indicator. I've got a 26.9 setting on there, and it follows pretty nicely the sort of shortish to medium term trends on Ethereum and on Bitcoin. And you can see the sell signal occurred over there when this weakness, the rate of change, if you like, plus the trend was not firming, gave a sell signal, and would have been good to be out of it if you are trading these cryptos. Right, nearly done. Looking at some commodities. This is uranium. Uranium behaving, following that trend line. This is a weekly chart, because uranium prices only come out weekly. Another example of me using gradient of channels. So a slower gradient there, and a quick and a speeding up, more rapid gradient over here, behaving on that, bouncing along the bottom over here. If this did take off, if this does follow the channel and the way that a commodity like uranium and some other commodities, you know, which are pretty volatile, react, you might see a quick run up to the top end of this channel. That's just the way these things go. So you might see a pretty rapid run up to you know, putting, you know, maybe 30-40% onto the uranium price. Now that doesn't always follow through into the URA, which is the uranium ETF. You can see that it does not track, the ETF does not track the uranium price very well at all. That's just a straight relative strength comparison between the two prices, or ratio, if you like. Does not follow the uranium price that strongly, but it does go roughly up and down with it. Sometimes it outperforms the uranium price, sometimes underperforms it. And a last one to look at is thermal coal. Iron ore. Iron ore. We've got thermal coal after this. This is iron ore. Again, using gradient. There's the gray dotted. I could make that a bit darker. We'll do for the next session, but it's broken out of this downward channel, come down, tested it, and it's a no man's land at the moment, really in a state of indecision, deciding where it's going to go. But and of course, it's just what you want to see here is a breakout above that light gray channel line that's coming down here, or if it falls back into the range, that's obviously the flip side, which is going to be more weakness in iron ore. The breakout of the week is thermal coal. Very volatile, as you can see, moves in pretty steep gradients, but it's broken out of this downward channel. Sure, not a lot of touch points over here, but it has risen out of that, and a 78.6% retracement on this run up all the way down to here, which indicates volatility. So if this does continue up, this price could rise from 150 up to 197, 200, which is one third, about 30% run up. So which will obviously translate into coal stocks. So that is where I wanted to leave it. Today, we've been going just over half an hour, and happy to take questions. Let's get the chat on. There are some questions here. Right, let's get into these. From Grant, thanks, Gary. Great to have you back doing these updates. Portfolio manager question, please. Do the summary and statistics reflect performance if withdrawals or deposits are made to a portfolio? Great question, Grant. It does for deposits, and we are currently working on the formula to handle withdrawals as well. So if you've done deposits and no withdrawals, then all of the stats are correct. But if you've done withdrawals as well, that can be slightly out, and we're busy. In fact, right now that's being developed and is being tested, I think. So potentially next release, I'll check with the development guys, but potentially next release we'll have both withdrawals and deposits in there as well. But certainly if you've only done deposits, the stats are all correct. Okay, Carl is saying, I'm trading the ETFs, the 3 ETFs. Do I wait until you say go to cash, IVV, IJH, or VTS? Firstly, Carl, I won't say go to cash, nor will any of my team say go to cash. We're not licensed to do that. You're managing your money, but you wait for the signals. So you're trading this mechanically. You wait for the signals, and if the signals give you exit signals and there's no entry signal from any other ETF, then you stay in cash. So exit signals will take you to cash. So you follow the process, follow the system, and the system will take you to cash. Not me or any of my team. And that's the whole idea of being mechanical, is that it's repeatable, but just as important is it's replicable. So you can do this on your own, and you can pick up the skills, not only the timing skills, but also the risk and money management skills as well. Some thanks coming in from John, Rob, Carl, pleasure. Yeah, as much as you enjoy watching these, I enjoy doing them. I really do. It keeps my hands on with technical analysis, and the picture tells the story, because that's really what we're doing. This is all about following the story of price discovery in the market. Because price, as you may have watched some of my recent videos, is the language of the market. We want to listen to the language of the market being price, not the language of English, which is very subjective and full of conjecture and emotion and everything. We want to put that to one side and follow the unemotional, objective way of the language of the market. Right, some more coming through here. Let me see if I can get any questions, or they're just comments. Okay, Vince has just told everybody, grant total return and annualized return date deposit. Okay, fantastic. Okay, there we go. Thanks, Vince. There we go. So what Vince is saying, if none of you read it, is that annualized return does take deposits and withdrawals into consideration, but max drawdown is currently the one is the calculation. Right, Richard saying thanks. Summary and to David absolutely. David's one of the team, does the Monday morning sessions, and also the ETF portfolio session he did last week. Was it last Thursday or the Thursday before? What is the ideal number of ETFs for a core US portfolio, please? Okay, so what Richard is asking there is, we talk about with our asset allocation, if you like, or strategy allocation, is you have a core satellite framework. And in a core satellite framework, which we didn't invent, it's pretty well known out there. If you've never heard of it, Google it. Effectively, you want to have, roughly speaking, and you can change these thresholds, 50% of your money in a core portfolio, and core can be passive buy and hold, if you like. And then you have your satellite strategies, which are more active strategies, which you can put you divide your cash up. You could go into leveraged crypto trading, if you like, and put 2%. Certainly wouldn't put much more than that into that, but into active strategy. But you can also be active in your core if you want to, taking a near passive approach. And that's what I think Richard is asking here. What is the ideal number of ETFs for a core US portfolio, please? So the thing here is, you just want to make sure you don't double up. For instance, having DIA, which is the Dow Jones ETF, and Triple Q and SPY, are all much of a muchness. And sure, the Triple Q is far more volatile, but you'd be doubling up on indices. So you don't want to have the SPY and also the DIA. So beware of that. Now, you also don't want to have too many ETFs, such that you, such that you actually are just averaging out your returns too much, because then you become more like the index. You want to try and do better than the index. So really, when you start getting to more than 5, you really are going to average out those returns. 1 is probably too few. If you passive, you're just going to hold through. But you could also, if you want to outperform the index, you could bring in like the IBB, which is the pharmaceutical. You could bring in semiconductors. You can go to ETFs that are outside the spiders, if you wanted to, but if you buy and hold. But you can go to the health ETF as well. So we wanted to get some upside. But in my view, I certainly, with my risk profile for my own in a core portfolio, I wouldn't have more than 3 if you're going purely buy and hold and passive on the core side of your core satellite framework. But what that does is it makes it tougher to select, but it also, you get off the fence. You don't want to go. The reason you're doing this and not putting your money into a mutual fund or a managed fund is that you want to get outperformance of the mutual fund. So you don't want to go and diversify so much that you become a mutual fund. If that's the type of return, because you got more capital that you'd like to get anyway in your core, and you want to average out returns, which means you also raise and average out your drawdown, then you can do that too, and you can go to more. But it just depends, again, what you have written in your investment plan. And if you're busy devising your investment plan, then you have to go through the process of asking yourself these questions, and you have to answer them. You have to get out of no man's land. You have to get off the fence and become specific about it. And remember, there's no one right answer in doing this. Getting 1 or 2% in your core portfolio and in your core portion of your core satellite framework, getting 1 or 2% better than the index, and certainly better than manager mutual funds, over a long period of time, the compounding is going to give you massive outperformance. And over a short period of time, if you've got lots of money in there, also that massive outperformance. Okay, sorry I went a bit long there, but it's key stuff, and people really need to think out not only the how you can divide up your capital through your core satellite framework. You also need to think, what entity are you going to do this through as well? So those are big questions. And what a lot of people do is they go, they're too big and they're too hard, so I'll just let somebody else take care of them. And then they find out, many years or decades later, that they should have taken more interest. Okay, pleasure, Vita. Right, any more questions here? Lots of thank yous, pleasure. These are just comments. Great to be back. Right, Mike, this looks like a question. Do the indicators for the US market give any indications as to whether US holdings should be hedged for the A dollar against the US dollar? This is a repeat question. And it's the same for people in the US. If you've got investments outside of the US, which I know a lot of people have been talking about for many years now, to diversify out of the US dollar. From Australia, people diversify into the US dollar. Is that whether you should hedge or not? That's a really, really tough question, because obviously you're trading 2 markets when you're doing it. You're trading the entity, or you're investing in whatever it is that you are investing in, the stock or ETF. And if you hedge, or then you also, whether you hedge or don't hedge, you are then trading the Forex pair. And you could drive yourself dilly. And not only in hedging, you could also, costs mount up as well in exchange variation fees, but also it adds another time dimension into this world. It becomes quite complex. From my perspective, and I know, and I've read books on this and spoken to other people about it as well, so I'm not unique in this, but I'm just telling you the way I do it, and a lot of the way other people do it, is I've just taken a long-term view of diversifying into another currency outside of the Australian currency. And so I've got a whack of money that I've put into the US, and that's a diversification against the Australian dollar. But I'm investing there. So rather than just taking cash and putting it in the US dollar and leaving it there as a diversification to the Australian dollar, I'm putting cash there and investing it. And so I just see that as a unit currency. And it really depends on your time frame to when you want to bring the money back and all those sorts of things. and how much flexibility you have and whether you need it or not. But hedging is a time-consuming, difficult thing to do, and you have to work out the time frame in which you run your hedges. The signals that we give are kind of medium-term signals on the AUD versus the USD, and it becomes quite complex. That there's no one answer to it. Your profile comes into it. Your time to when you need the money to it comes into it. How much capital you have, how you view your diversification between different currencies. All of that comes into it. So it's quite a complex equation, but and it's one that you need to go through yourself and answer. And when you answer it, put it into your investment plan, as all the other things I've discussed here today. The core satellite. Write that up into your investment plan. The actual the task, the activity of doing the writing. Your conscious and your subconscious brain throws out questions to you all the time while you're doing that. So different to just trying to do it on the fly. In fact, doing it on the fly doesn't work. You got to write this down, go through the process, write it down. More questions come out. We've got tons of learning material, education material that ask these questions of you to formulate your investment plan. But as you write, more questions will come up that we haven't asked, that you'll think of with your unique experience and life that you've lived, and your unique situation as well. So put it into your investment plan. Okay, another question from Richard. Should have mentioned that as a core, that is a core portfolio with timing. Excellent. Okay, so if you're doing it with timing, Richard, as per the conversation we did, well, then 2 or 3, you don't want 1, and to me, you don't want 5. So it's 2 is going to be, you're going to have bigger position sizes. It depends how much capital you have. If you're doing it with multiple hundreds of thousands of dollars, then you might run into some issues with actually liquidity and getting the ETFs done, particularly US ETFs, because obviously we're trading in the US. Well, if you're doing the US ETFs on the Australian market, well, then you're in a different time zone. But if you're doing the ETFs and they both involve exchange variation in the US market, well, then the trade's happening outside of our hours, our sleeping hours is happening. And so you don't want to get too big on your positions. So look at how much capital you're doing it with as well. But 2 is probably too few. 3 is the Goldilocks level. And if you've got a lot of capital, you might need to go to as many as 5, but certainly wouldn't be doing it with more than 5. And go through again, look at your size of capital, look at, I'm not sure whether you're doing ETFs on the Australian market, US ETFs on the Australian market, or US ETFs on the US market. But certainly, you can get filled far easier by doing the ETFs in the US market. Right, looks like we've run out of questions. Thank you very much for those. Really enjoy the questions as well. And we'll finish it there. And if there are more questions, this is going to go up and you ask questions in the platform that you watch, either in Kajabi or on YouTube. Ask away and we can answer them as well there. So thank you for your time and attention. I'll be back in a couple of weeks' time, and we'll look at the markets then, and we'll see whether the hanging in has continued to hang in, whether it's risen and approaching a new peak or not, or whether it's fallen away and making a new trough. So, but keep an eye on those charts that I spoke about today. Until then, I wish you consistent and objective investing.